For those of you who might be new here, this is the B Project, which has been organized by Angela Rice. B stands for Business and Entrepreneur. You can find the group on Facebook if you search for the B Project. B is spelled B-E because it is for Business and Entrepreneur. And you could join the group and be part of this group where it's completely free, where there are a lot of experts in different industries of the business world that have teamed up together to give free tips and advice and tools and training to be able to help you grow your business no matter where you're at in your business, whether you're just starting out, whether you were doing well and then COVID hit, or whether you still are doing well. This is a great place to be. There's awesome people here, and there's a lot to be learned and done. So welcome to anybody who's new, and welcome to those of you who are returning. We definitely love returners as well. And so the disclaimer that I know that Angela likes to put out there for safety reasons, of course, is that while everybody is an expert in their field, everybody is volunteering their time here, and we are sharing things that are, to the best of our knowledge, true and effective. But if you utilize something that one of our experts during these several months share with you and it doesn't work, or it doesn't work like you thought it would, you're doing these things at your own risk, and nobody on these trainings can be held liable for the information that they're sharing with you. I want to introduce today's topic. As you can see on the screen, forecasting and budgeting is what we'll be talking about today. But I want to mention a little bit about what that means before we jump into the expert speaker who knows way more about it than I could ever dream of knowing about this subject. So there are lots of bumps in the road when we own a business. Anyone who's ever owned a business of any capacity knows that to be true. It's like a roller coaster being an entrepreneur or a business owner. One of the biggest areas of challenge for most people are finances. Some people don't have them. Some people have them and don't know how to use them. Some people don't know how to obtain financing. There's just so many issues around this topic. And, you know, a lot of people are terrified to even speak of this topic. So it's really good when you have somebody who you can trust to help you navigate through this area of business. So if you need help knowing how to forecast, to budget, to manage your finances, anything like that, possibly even applying for grants and getting funding for your business, all those different things, Lolita's here to help. And she's got a presentation for us. After the presentation, there will be time for questions. So please make sure that you're asking questions, because this is the person to ask. She's the one who knows this information. So with that being said, help me welcome Lolita. She has a bio that is one of the most impressive bios I've ever seen, but it's super long because she's done so many amazing things. It's posted in the B Project if you want to see how awesome she is. I don't want to read it right now because it will take me forever, and I want to give more time to her for this topic. So Lolita, the floor is yours. Take it away.
I've been in business now for about 27 years. I have a tax office in Maryville that I've ran. And the beginning, you know, was a little bit of bumpy road, but I've always stayed focused on where I wanted to be and what I wanted to do. A lot of things I've learned through my educational background. I went to college and my major was in accounting initially. And then I changed that major over to business, but I got a concentration in accounting, took a couple of tax classes, and I realized that's where I wanted to be. I would like to have been more involved with clients, one-on-one individuals in my community, so that I can continue to empower individuals more on a one-on-one level than on a corporate level. But I have learned a lot that I am now able to share quite a bit of information across the board with individuals, business, nonprofit organizations, and such. So I am glad that I was given this invitation. So I'm going to do my best in my presentation. And of course, if you have any questions, I'll be glad to answer them. I was chosen to discuss forecasting and budgeting. I'm going to try to tie that into taxation because that piece is very, very important when it comes down to running your business. And a lot of times there People are very lost when it comes to taxes, and they are also it's because it's so complex. I mean, taxing to me is just like a lawyer's office. You go in for a personal injury, you just can't see any lawyer for a personal injury. So the tax laws can be pretty complex, and so you don't always get the best answers from a CPA, even though a CPA can have a broad amount of information. It's just that sometimes they may not be able to address your specific issues without being more involved in their research and things of that nature. So forecasting and budgeting, predicting the financial future of your business will enable you to fix problems before they become a major issues. It's very, very important that you understand what type of financial position your business is in, what it's going to need, and how to budget that particular type of business, because every business income stream is not the same. Okay, so I'm going to first talk about the different entities of taxation. So you have your sole proprietorship, which most people start off as a sole proprietor. And that information, when it comes to taxing, is usually filed on your Schedule Cs. You have your single member LLC. That information is usually filed on a Schedule C. A lot of people think that when they do an LLC, that it's filed totally separate from your individual tax return. But that's not always the case. It depends on what you do with that LLC. So that LLC is sometimes, in most cases, filed on your Schedule C in your individual 1040 tax return. Unless that LLC is linked to a partnership, a C corporation, or an S corporation, it is filed on your individual tax return. You have your partnerships. Those are filed through 1065s, which are separate from your individual tax return, but it is eventually going to be provided a K1, and it then will be filed on your individual tax return. Then you have your C corporation, which is by default if you decide that you want to take your business into a corporation. You are then going to file that corporation separate from your individual tax return, and you will then file those on your 1120 series. But the C Corp is the 1120, the S Corporation is 1120S. And then you have your nonprofit organization, which is taxed on the 990 series. So it's a lot of information when it comes to taxation of your business. You should begin your journey when you're sitting down and trying to get your finances established. You want to try to make sure you understand where exactly your taxes is going to, how you're going to be filing your taxes. You have your startup costs when you're getting out into setting up your business. We're going to talk about some of the fees that you will be incurring, like when you start to budgeting and forecasting. You got your legal and accounting fees that you would start to. Can you still hear me okay? Everybody can still hear me? Okay. You have your business deductions, your startup, I'm sorry, when you're starting up your business. Every business is given a deduction for startup costs of up to $5,000 in your first year. So when you're out trying to get your information, dealing with your articles of incorporations through the state, any fees that you incur when you're starting up, like your business plans, your research expense, your borrowing expense, your advertising, your legal and financial consultations, insurance costs, permits and license, leasing, rent costs, staff, wages, contractor costs. Well, those things are all written off on your individual tax return or on your corporation's tax returns. But like I said, you initially get a startup cost for $5,000. So you can deduct that on your individual taxes. And if you're working at the beginning of starting your venture as an entrepreneur, you can write off $5,000, and you can write that off against your individual tax liability. So that if you have of your business income. So, but if you end up having more startup costs than the $5,000, you would have to spread that out over 15 years, where you can deduct that against your revenues that you will have coming in from your business. So you'll be able to write that off against your future business income. So there's some advantage to having that. And of course, every business, like I mentioned earlier, have different streams of where their revenue streams are labeled differently. So if you are in a service industry, such as myself, I'm not going to be, my income would not be considered sales income because I don't sell, I provide a service. So therefore, your fees would be considered service fees, or your revenue stream would be service income. And so but if you had a business out there where you were in sales, then of course it's goods sold. The reason why it's important to understand your revenue stream in the projecting of when you're projecting your income and you're doing your analysis for your income is because you have to base your cash flows and your income, your predictable income, off of the type of services that you, or the type of people that you're providing services for. So you have your revenue from goods and sales or service fees. This is the one core operating revenue account for most businesses, and it's usually given a specific name such as sales revenue or service revenue. Then you have your interest revenue. This account records or records the interest earned on investments such as debt, securities, and this is usually a non-operating revenue. Then you have your rent revenue, which of course goes to those individuals who decide to go into non-passive income or passive income when it comes to real estate. You have some that flip homes that would then go back to a different revenue stream because it wouldn't be rent revenue. It would just be like sales. So if you buy a home, you flip it, you sell it, that's a sale. If you renting your property, then it's rent income or rent revenue. And this account records the amount of earned from renting out buildings or equipment, and it's considered non-operating revenue. Then you have your dividend revenue and the amount of dividends earned from holding stock of other companies. This is a non-operating revenue as well. So like if you were a shareholder in a C corporation, you would then be getting revenues from stocks that you have in that as a shareholder in that C corporation. So out of the 4 revenue streams discussed, recurring revenue is the most predictable income to a business. So that is the one where you are able to do more predicting on how you're going to budget and forecast your income. When you have that one predictable income where you are able to forecast better to a business because it's expected that the cash inflow remains consistent with a stable customer base. In contrast, transactions-based and service revenues tend to fluctuate with customers' demand and are more difficult to foresee. So seasonally, it's also often a major factor contributing to the vulnerability in sales of goods and services. Project revenue is the most volatile and risky revenue stream out of the four because it is largely contingent on customer relations. Therefore, businesses needed to invest a considerable amount of time in managing their relationships to maintain this revenue source. That would be, to me, more of your sales if you were someone who had retail. So it's very difficult at times to determine that particular line of business, of what type of businesses the audience have. But for instance, my revenue is unpredictable. It is definitely something that I know is going to come, but how much will come is kind of unpredictable because I have a tax office. I can predict that as long as the tax system is in place, I know that I'm going to have some revenue. I just don't know how much revenue. But I do know that I will be able to have some revenue. Unless I lose my relationship with my clients, then I will just I can just about assure that I will have some income coming in. Understanding the revenue streams enables a financial analysis to realize the pattern of cash inflows and therefore be able to quickly observe unusual movement or changes in revenue trend and identify the cause. This is when an analysis performs financial analysis and provide a meaningful explanation for variances. I realized that in the previous segments that there was some discussion on legalizing your business, and then there were also some discussion on location, all of which are very, very important because, well, legalizing your business, okay, by this time, you got your business, you know what type of business you're going to have. You've taken the necessary steps to make sure that you have identified your business. You've gotten your EIN number. You've gotten yourself registered with your state. And then you have a location. Now, location can sometimes interfere drastically with your projections if you're in a bad location. There are some businesses that start up and end up in the wrong location, and no matter what your customer base is, if you're in a bad location, it's hard to project, in all honesty, a really good analysis on your income that you would have coming in. And just as you have your revenue, you have your expenses, everything related to the operation of your day-to-day operations, including where most people don't understand some of the things that they could write off as far as expenses, like your vehicle mileage. You have some businesses that are out there, like you have your Uber drivers. You have something as minimal as an Uber driver to as a corporation. When you take your vehicle and you're driving here and there, of course, you can write off your vehicle mileage. You have your depreciation of fixed assets. You go out, you buy equipment, you own a building, or you own any property related to your business, you're able to depreciate that. Some things you can write off right away as a deduction rather than take your depreciation. Then there are things that you can depreciate over a period of time. You have your business use of your home. Some of you who are in business, there are some things that you can write off directly, and then there's some things you can only write off indirectly. So if you have a business use of your home and that home is not exclusively for your line of business, by being your home is not exclusively used for your line of business. It is a indirect expense that you could actually take off for your business. So if you have a mortgage, you can indirectly write off your mortgage interest. If you have taxes that you pay, you can indirectly write off your business taxes, insurance, and even your utility bills. You and those major repairs that you may have on your home. If it's exclusively for the business use or the business portion, you could actually write off those repairs. So these things are very important when you're dealing with getting into the analytics of your budgeting and your forecasting. They're very important so that you can budget appropriately. Taxation is just one of those areas that, you know, a lot of times we lean on our personal or professional tax person, but it is good that we try to get some knowledge of these particular steps and or income and expenses so that you can project your business outcome. The cost of goods sold is one of those businesses that is specifically for retail. So you have a retail business out there, and a lot of times folks do not take advantage of this particular deduction to me, because they just write it off as supplies that they purchased, and they're not keeping good inventory. So any retail that you have, if you have a retail business, you want to make sure that you are keeping track of your beginning inventory and the purchases that you make, your ending inventory, because it could yield a pretty good write-off for you. As far as your returns and allowances, this is another one. If you're in retail, there are times that you do get things returned to you, and so you're able to write those returns off as a deduction. So you definitely want to make sure that you take the time to keep track of those types of things. And again, these things are very, very important when you're collecting your data for your budgeting. Okay, so now this part here, when we're talking about your financial statements, this is where your CPA comes in. But at the same time, they have a lot of software out there now that could assist you with some of these statements. When they have to be signed by a CPA, you do in fact need a CPA. But if you're just, if they're not requiring a signature, some of these things you can do through software, or your advisor or financial advisor can assist with it also. So it's that show me the money, because at the end of the day, when you are having to make major purchases, you're going to have to reflect back to, or at least have some financial statements that you could show your banker. There are four main financial statements. One of them is your balance sheet. The other is your income statement and your cash flow statement, as well as your statements of shareholders' equity. Now, on your cash flow, that is one of the most important documents that, you know, because it actually shows the exchange of money between a company and the outside world. That's one of those statements that you would actually get your hands on pretty quickly, and it's able to turn into your bank without you having an actual tax return filed. So it gives a snapshot of where your business is at that time. And so it's one of the out of all of the 4 documents, that one right there. You want to be sure that all of those other things that we mentioned at the beginning, I'm gonna go to the beginning of the slides, because this is when you're dealing with your revenue, and all of those expenses and things like that. All of these things play a very important part in those financial statements, and all of these things will end up on those financial statements. So if you have these particular expenses, they will be journalized, and they will be sectioned off, and they would definitely show up on your income statements. Heard that or not, but you want to keep a really good track of journalizing everything that you're putting out, everything that you have coming in, because when you're predicting, these are very important as far as your financial statements are concerned. And it doesn't hurt for you to monthly or weekly forecast, or I would say that get in the habit of trying to do your forecast at least monthly, or quarterly. You get in the habit of forecasting, then you're on the road of a really good habit, because it definitely allows you to closely monitor your finances and develop strategies before major issues could occur. So I'm going to share some tips with you. Like, when you're starting a business, it often costs more than you expect. Okay, so it depends on your image, how you want to look, but it definitely can be more expensive than what you actually thought. So if you predict that you're going to spend $5,000, it wouldn't be a bad idea to increase that by at least 20%. If you are in sales, and I'm not sure what audience I actually have, what types of businesses that you all actually have, but if you are in sales, a sales industry, estimating the sales of your business will generate over the forecast period can be difficult, as I mentioned earlier. If you are starting a new business, you can base your estimates on market research and industry benchmarks. For an established business, take into account previous sales data, which helps as far as forecasting over the same time period. You will also need to consider the current market and other economic conditions, like COVID-19. So with us being in COVID-19, I'm sure last year when everybody projected and did their analysis, no one had no idea that we were going to be faced with this COVID-19. So y'all have to regroup. So no matter what you were in, no matter how great of a no matter how great business was the year before last or last year, no one could project something like this. So in times like this, hopefully we had enough saved up. But for some of the business, as you can see out there right now, they are having some major setbacks, even if they were already struggling. And we're talking major corporations like, you got your Macy's, your J.C. Penney's, you have your major restaurants, but they struggled. And so they were struggling before COVID. And so the situations like this can set anybody back. But you don't want it to get to a point where it just knocks you out the loop. So a tip for something like sales industry, regularly review actual sales figures against your forecast, revising your forecast accordingly if the results differ from those expected. Being able to identify the reason for the difference may help you to address a problem before it becomes a major issue. In regards to the cash flow statement, and I'll elaborate a little bit here on that one, because a cash flow forecast estimates the amount of money you expect to flow in, receipts and out payments of your business, including projected income and expenses. A forecast is usually done over a 12-month period, but could also cover a shorter period, such as a month. Cash flow forecasts can help you identify when you may have extra cash available or experience shortages, so you can make the right decisions for your business. It's important to review your cash flow forecast regularly against actual results. A forecast can provide warning signs that may help you to avoid future financial problems. Watch out if your cash payments are more than cash receipts. You will run out of money. So, it's always good to make sure that the business have a cushion or have something set to the side. If you find yourself going into that cushion or that side savings, because just like us, in our personal life, we have our financial budgets that we have at home, we have our savings. And so even though you're running a business, you may have profits, true enough, but you still want to have the business set up a savings. So you want to make sure that you do that. Lack of cash flow can result in business failure, even when a business is profitable. So again, you definitely do not want your expenses to outweigh your income. And speaking of expenses, expenses forecast estimates your ongoing operational costs over a period of time. Business expenses may include, as we said, rent, insurance, vehicles, advertisements, employee wages, accounting, and legal fees. You have professional fees. You should always try to make sure that you consult. Some professionals provide free consultation. I would, for any business, suggest that you take advantage of free consultation as much as you possibly can. Definitely do your research in the type of business that you have to make sure that you are well informed on your business and your business needs. And if you are starting a new business, base your forecast on market research and industry. If you are already operating a business, use records from previous years to assist you. But if you are not and you're new, at this whole thing. It's going to be trial and error. Um, it's not going to be perfect, no matter how much we inform you, and we being the quote unquote experts. Some things you're going to learn through error. But again, the most important thing you can do for your business is to always not overspend. Don't do too much too fast. I started my business in my home, and I started I made an office in my home. I made a waiting room in my home, and I ran that business in 10 years. And the business began to grow. I was very nervous outside of my comfort zone, but I didn't go outside of my comfort zone too fast. I actually had to sit down, and even though I had my savings account, my checking account, I had to really sit down and do some serious forecasting, because my next move was going to be a major move. I was actually going to take the business to another level. Some take the business to another level too soon. I'm not a very risky person, so sometimes not being too risky cannot be good, because you didn't make your move soon enough. So when you do make major moves, make sure you have a clear picture of how that cash is flowing, and you have really paid attention to the history of your business. So I decided that I was going to be moving out of my home. And I went back over the 10 years of that business. I saw where I was at, where I started, and where I was at. And I projected from where I started, which was 10 years in this business at the time. I look back over where I started and where I was at, and then I projected where I wanted to be. How could I grow my business to allow me to be safe outside of my comfort zone? Or now I'm getting ready to start new expenses. I'm going to have rent, real, not my mortgage that I paid every month. I'm going to have some rent that I have to pay. I'm going to have to set the office up with equipment, and I'm going to have to spend more supplies. And so it was very risky for me, but yet it was a move that was necessary. So in my projecting that move, I actually had to sit down with my cash flows and find something that is affordable. Do not do anything that's going to be more than what your projected income is, because then you don't want to struggle when you do get into that next step of your business. So you definitely want to make sure that you are keeping track of your expenses and your income to the point you can look back over all of that, over all of those years, and determine if your business is ready for that next step. If you are a sole proprietor and you are completing your taxes on a Schedule C, a lot of times what happens with that business, with that particular entity rather, or with any entity, we're trying to make sure that we don't have to pay so much out in taxes. So we try to take advantage of every single deduction that we actually have. So your deductions on your taxes and what you actually have in your bank account are probably not going to be exactly the same. So your bank account, business bank account, may end up having more income in it than what your tax forms are actually showing. That's a good thing. I mean, because we don't want to give everything we got to Uncle Sam, as they call him, or the government. So anytime we can take advantage of our deductions and write them off, that's always good. But our bank accounts, um, we want it to always show that net profit. Um, so as a sole proprietor, when you're getting ready to make some major purchases, though, and your Schedule C is showing a loss, to any entity that's reviewing your cash flows and your financial statements or your tax forms, when they see that business is struggling, it's going to be hard to get anything in regards to property. So there are times that you definitely want to, every time you want to make sure that you're saving on your taxes, where you're not having to pay out so much in income taxes. But there are times that you really need to not take, then you will not be able to make any major purchases. So there are times that Schedule C, you may not want it to show, and there are times when you're projecting a major purchase, you're going to have to show income. Because if you take your Schedule C or business income tax forms to any entity and try to get a loan, they won't see revenue. So that's not going to be a good thing. So you just have to make a projection. If I'm projecting to go out and buy a building so that I can not pay rent anymore, I need my income or my business income to reflect revenue. At that point in time, I may have to decide not to take all of my expenses, and at that time, I'm going to have to pay the government taxes. But it's for the greater good of my business. Um, when you venture, and that's on your regular Schedule C. It's the same thing when it comes down to whether you're an LLC or if you're an LLC or if you are a partnership. The partnership is issued a Schedule K, and that Schedule K income, when you know that you're going to be making major purchases, should reflect income, or if you've taken advantage of all of your expenses and deductions, then it would show a net, it would show probably less income. Out of these entities, the greatest entity as far as taxation, to go with an S corporation, you will probably have less taxes because those taxes are not based off of employment tax. Although you as an S corporation would be paying tax as a shareholder, if you're a single member shareholder, you would definitely have to pay withholdings on yourself at some point in time through the S corporation. And then if you're a nonprofit entity, well, there's no profit to be shown. There's revenue and income that comes in that you could use throughout your business, but there's no profit to be shown. Well, there's no taxes on your profit. It's best that you don't have profits that you're showing, because then that's a different can of worms when it comes down to your nonprofit organization. I think that I may covered everything. Um, yeah, I think that covers my side. That covers everything that I had to share.
All right, awesome. Thank you, Lolita. Let's open it up now for questions. If anybody has any questions to ask Lolita over anything she's gone over or anything that maybe she didn't go over but you still are wondering, you can either unmute yourself and ask or raise your hand. No? No questions? Lolita, you must have done a fantastic job explaining everything.
Actually, I got a couple questions. I want to get back on camera. Can you guys hear me?
Oh, yeah. Go ahead, Antonio.
Yes.
You can hear me?
Yes.
Yes.
Excellent. First of all, I just wanted to say, Lolita, said it's your first Zoom. So I wanted to say good job.
Oh,
great job.
No.
Just want to say great job to you. Had applause. Sometimes doing these things can be daunting and be overwhelming. So great job, good information. It looks good as well. So I do have a couple questions. Let me get my notes here real quick, and I want to just ask you two questions. The first question is in regards to business credit, in a sense. I know that may not be your exact area, but if you can, appreciate it. So I get a lot of questions from other entrepreneurs about building business credit. And I'm not sure if you're familiar with the economic disaster injury loan, the economic injury disaster loan with SBA.
Yes.
But my question with that, a lot of people qualify for as a sole proprietor, small business. You don't have to be a big business. You get the advanced grant, and then they offered you a loan if you qualify for that. Now, the loan is we know the loan is money you have to pay back at a low interest rate. But here's the question around that. Would you suggest individuals who may not necessarily need the loan to take it and for the purposes of building business credit and paying it back?
Very good question, Antonio. Very good question. I would have to honestly say, because business credit is very difficult to establish outside of your individual self. You know, if your business is linked to your social security number, or if you got an EIN number and you can't seem to establish credit without putting your information on the application.
Correct.
So
Correct.
I would honestly have to say yes, because of it. Because what you can do is, you know that you don't necessarily need it, right? So what you can do is you can take the loan and begin, if you're going to use it specifically for building the credit up, if you don't really need it, and it's specifically for building your credit, then you get the loan and you take the loan money and pay it back in, by using the loan money. And at the same time, you're getting what you want out of it, and that is credit history or credit worthiness. It's just very difficult, though, no matter how great your credit is, for lenders to lend just to your business itself. That's the challenging part that we constantly face on, no matter how great our credit is. Getting that lender to lend you the money without your social security number attached to it is the challenging part. So even though your business is going to have a great credit score, if your credit score is terrible, it still might be a struggle. But that's the challenging part right there. If you can do some research and find lenders that will lend without your information being linked to that, then it's worth doing. You want to build credit history for your business, if that all makes sense.
It makes excellent sense, Ms. Great. Thank you for your answer. And I should have put a disclaimer that you have to be disciplined to pay it back. Not taking the money if you get a loan from the SBA, the low interest rate, and using it for the wrong things, but actually using it for that particular purpose. So thank you Thank you very much for the information. Now, here, I guess the second, you said something that made me think about a second part to that question. If you do take money from the SBA, for example, because of the pandemic, I guess the question would that be, is that going to be reported on the business credit? I guess you kind of answered that, but I want to make sure I understand correctly.
I would have to honestly say yes. We try to get into the fine print of the devils in the details with that SBA. Okay.
Right.
They do check your credit score. If your credit score is less than 570, then of course they reject your application for the loan. But if it's above that, then you actually get it. So I'm going to say that because your credit played a part, that they should be reporting your payments to your credit file. Now, I cannot edge and stone that.
For personal and business, or just personal, one or the other?
Well, being that I'm going to say that it has to be, because it's a business loan, they should be reporting it to your business file. But 9 times out of 10, it may be both. But it's a good question, and it's definitely something to be solid on that answer before you actually go at it for business credit purposes.
Perfect. I got you. I understand. Thank you so much. That's really helpful. The second question to that is something that I get asked a lot by other entrepreneurs. Particularly, my wife is in business, and she's an independent consultant with the company. So she has a lot of people in her sales organization. And the question that comes up quite often, particularly right now because of the unemployment situation, a lot of people getting unemployment, and they don't want to do anything to mess that up, or to mess that up, they really leery of concern, or disability. I know that the federal laws is you don't have to report anything on your taxes until you make $600 as an independent consultant or independent contractor for 1099s, regardless of what you do. I'm very aware of that. How does this affect the unemployment situation? The person is drawing unemployment or disability, but yet they want to start a part-time business, and at some point of hoping to get to a point where their business, like you did in your home, which is, first of all, awesome, to move from your home to an actual office space. People don't ever make that move. Some people never make it to that level. So But to get to that point, they're scared that they're going to mess up that, for lack of better words, that stable income coming in, whether it's just a couple $100 or not. It's that security of that until they get to the point where their side business or their proposed business is going to be able to replace that income.
Okay, I heard a few things. Give me one moment. I just
let me give it to you. Let me give the question. I know I said a lot in there. So let me ask the question very concisely, and I apologize for being cluttered. The question
no
is,
problem.
The concise question is, for individuals right now who are drawing unemployment through the COVID pandemic, drawing unemployment, okay? Do they have to report every single income they get coming in right now when they're just starting their business? And if they do, if they made $100 this week, would that affect their unemployment?
Now, okay, you're speaking in regards to reporting it to the entity that's handling the unemployment. That's what you're referencing that question to?
Yes.
Well, that's a very good question as well. Unemployment, whatever the rules may be in regards to this COVID-19, I do know that if they may have set some standards for that, and I honestly say I'm not really sure, but because I know if it were just a regular situation, we couldn't get unemployment through if as business owners. Okay, we couldn't get it. So the fact that they're giving it to us because of the COVID-19 makes extra opportunity. I'm not sure what rules may have come with that unemployment. I didn't follow it to that extent. I do know that it's going to be taxable income when you do file your income taxes. But as far as would they cut off your unemployment if they see any signs of income coming in from your entrepreneurship or your business income? I'm going to probably say it probably would not, depending on how much you probably made, but I can't edge and stone that answer though. And as far as, I think I heard you mention about the $600. So the $600, that's for if you are a line of business, if you have a business and you have workers, if those workers, if you paid those workers $600 or more, you're supposed to give them a 1099. Okay, that's where the $600 come in at. But if you yourself as a business owner made a net profit of $400 or more, you're required to file an income tax. So the 600 to 400, that's where those two numbers come in at. So if you paid out a contractor more than, $600 or more, you are required to provide that contractor a 1099 from your business. So they would have to complete a W-9 and you have to give them a 1099 miscellaneous form. That's where the $600 come in at. I heard you mention the $600 earlier, so I just want to make sure I was clear on what you were saying and then elaborate on that a little bit to make sure you understood that.
Thank you.
Mm-hmm. Now, what type of business do you have, Antonio?
I have a IT company.
Okay, great company.
Thank you.
How long had you been in business with the IT company?
Officially, with my current tax ID number, 15 years.
Oh, good. Okay, real good. I can use an IT for the office. I'm gonna be honest with you, so make sure I get your information. I am serious.
Yes,
I am truly looking for an IT person. But again, yeah, I've been doing this for, like I said, 27 years now. So I've been in my current location for 10 years.
Wow.
When I was asked to discuss the forecasting and projecting, we do a lot of the entity information. I kind of felt like I was all over the place with it. But as far as being informed on these businesses and getting everybody set up and making sure everybody is in the right place financially, we definitely try our best to do a very good job at doing that. So you all could feel free to definitely contact our office at any time. The information is definitely in the slides if you have any questions. But I do want to say this about the SBAs though. We have a lot of individuals that were out there that applied for it. And when they put the number of employees down on their SBA application, they put a total, they may have put 4 or 5 employees. If you're not paying those employees actual income from W-2 wages, they are not considered employees. But some have a misconception because they do pay people that those are considered employees. Like if you pay someone to help you lay concrete, or if you help someone, if you pay someone to do some work for you, if you've not given them a W-4, they are not an employee. So we need to make sure that you all are very clear on that. Because you do have a lot of people that was out there taking advantage of the SBA application. It was very, very easy. And so you did have people that when they put down the number of employees, they put down more than themselves. You are your only employee unless you've given that employee a W-4. If you didn't give them a W-4, they are not an employee. So what the SBA was doing was advancing $1,000 per employee. So they may have advanced $10,000 to you. That's because someone may have put 10 employees down. But if at the end of the day, there will be audits. And with the SBA loans or even the advancement, you can't buy certain items with that. So if someone went out and bought vehicles, you're not supposed to buy vehicles with it. You can't buy anything, no fixed assets with that SBA loan or the advancement. Well, with the advancement, there's some devils in the details with the loan, but with the advancement, you're not supposed to buy fixed assets with it.
All right, thank you for sharing that, Lolita. And great questions, Antonio. Angela, do you have any questions?
No, I'm quite good. Thoroughly enjoyed everything. So thank you, Lolita, for sharing your knowledge with us. Really appreciate it.
You all are too kind. I just felt like I was rattling on here. I'm gonna get it together. I'll be ready for that next Zoom when I guarantee you that one.
You did fantastic, Lolita. I'm glad that you were able to share your first Zoom experience with us and let us know how we can support you in the future. I'm glad that you have your contact information up here. So that way, even if people aren't on the call, they'll be able to see this when they watch the recording. And I think that we're right at time too. We're supposed to end about 7:15. It's about 7:12. So great job on your time. And thank you to those of you who were here today.